Everyone was cheering for a Fed rate cut today, and they got it. And they were hoping that it would spark an endless bull run as the Fed dumped massive amounts of liquidity into the economy. But what happened? Just the opposite. Stocks started to sell off. Gold sold off. Because what if this boost from the Fed is really a desperate signal of doom? And that's right, with repo markets flashing red, a brewing dollar shortage squeezing liquidity, and subprime cracks that are widening, the Fed isn't preventing a recession. They're admitting that one's barreling right toward us, ready to wipe out jobs, crush your 401k, and spark potentially another financial crisis. Now stay tuned, because I'm going to show you why this good news from the Fed is really your recession nightmare. But not to worry, I'm going to show you exactly what you need to do to not just survive, but thrive in this coming crisis. Plus, tonight's show is brought to you by Outside the Box Capital for Oncolytics Biotech. You can find them on the NASDAQ and symbol ONCY. And they're a pioneering company developing groundbreaking cancer therapies to help the immune system fight hard-to-treat tumors. And here's the best part. If you're an Elliott Wave trader, the stock is still holding on a 6-month volume profile right at the beginning of Wave 5. It's not too late. This is one trade you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. And the verdict is in from today's FOMC announcement. In a split vote, they slashed federal funds rate target by a quarter point to 3.75 to 4%, the second cut this cycle. But what is the big pivot here? And believe me, this comes to really no surprise. They announced quantitative tightening will wrap up on December 1st, a direct nod to those repo market tremors and reserve drains we've been warning about. Just as I predicted, we get a 25 basis point cut and the announcement that QT would end in the coming months. Sure enough, that's exactly what the Fed did. And why? They didn't want to spook the markets. And what did they do? Well, obviously, they're spooking the market. But I want you to see why this is such a critical turning point here, because we've reached the area where the Fed starts to shift their focus from inflation, and notably, it hasn't been coming down as they've been claiming, all the way into the labor market, which we know is unwinding. And if the holiday season comes in weak, we're already hearing from many small businesses, we're hearing from retailers, they're either going to lay off or shut down, or maybe they're going to be faced doing both. Now, let's dive deeper into the Fed's massive balance sheet machine and why ending QT isn't the hero move that everyone thinks, because it could be accelerating us right toward that recession cliff. Now, the Fed expanded its enormous portfolio, sometimes called a balance sheet, during the 2007 to 2009 financial crisis, and again during the pandemic when it bought a colossal quantity of government debt and mortgage-backed securities in an attempt to stabilize markets and stimulate the economy. And see, at the time, and this is always what we hear, the Fed wants people to believe that they're printing money, injecting liquidity in the economy. And the problem is, people do believe it. And it worked, because what was the Fed's objective? To get people to stop selling stocks and start buying them, because they knew if the market continued to crash, the entire financial system would be destroyed. But here's a reality check, because quantitative easing isn't some magical money printer. It's nothing more than an asset swap. When the Fed purchases securities, it creates reserves, or electronic cash, that the banks hold at the central bank. And when the securities mature, that electronic money drains out of the financial system. But a key point here that I want you to understand is that electronic cash that's on hold at the Fed, it can't leave the banking system. It can move in between banks, but it can't leave the system. That's why it's not money printing. Now let's fast forward to 2022, because they've been unwinding their balance sheet, and now it's dropped to about $6.6 trillion. But the officials, they've been worried, because they need to keep control of short-term interest rates. And if they were to jump, well, it's a sign of stress in the financial system, and that volatility could affect mortgage rates, business lending, and the flow of credit to the economy. And we've already been seeing some red flags. We've been seeing banks borrowing at the upper end of the federal funds rate. We've been seeing SOFR rates, they've been moving higher. And this is not a good sign, because what's saying is the banks that do have money don't want to lend to the banks that are short money. And all this starts to point back to a telltale sign, and it shows up in the repo providers. They're getting nervous, and normally they provide loans in the overnight market, and when they don't want to, it's a sign of stress and liquidity is drying up in the system. I want to take a quick look at this stock chart for our sponsor of the show, Oncolyx Biotech. Again, you can find them on the NASDAQ, and symbol ONCY. And here's why you do. If you're an Elliott wave trader, check this out. There is wave 1. Pull back into wave 2. There's your third wave on the way up. Pull back into wave 4. Holding its 6-month volume profile. That's a red line across your screen, setting up a big wave 5 move, potentially breaking out over $1.51 per share. Again, stay tuned to the end of the show or check out the pinned comment or description for more information. And as a result, banks are more regularly tapped a Fed lending facility because they can't get the cash they need from the repo providers, which is designed as a safety valve that lets them exchange securities for reserve, offering another sign of reserves becoming less ample. Now, I want you to see this chart, this repo chart here, because we keep hearing about reserves, but all this is nothing more than people that have a security, a treasury agency or mortgage-backed security, going to the Fed to get what they can't get from the financial system, which is an overnight loan for cash. They're not actually getting reserves, they're getting cash here. But let's dig a little bit deeper, because it's not just reserves that are drying up, it's a broader cash crunch. And that's the real issue here, because you can see it's fueled by this global dollar shortage that everybody is short right now. And this is a problem, because when an economy starts to slow down, what happens? It doesn't have enough dollars. And what do you need dollars to do? Pay on the existing debt. That's why you start to see delinquencies rise, you start to see defaults, you see cracks in subprime, you're seeing everything that we see right now, and it's all because there aren't enough dollars in the system. And that's why we're seeing stress, again, building up in the subprime space, because what we're facing right now is liquidity is drying up, credit is freezing up, and when that happens, businesses cut back on hiring, or worse, start layoffs. That's exactly what's happening right now. Now, I know many of you are gold bulls, and long term, gold is likely to go a lot higher. But why is it selling off today? Because isn't another Fed rate cut bullish? Well, hold fast. Because gold's current bout of weakness is in line with history, with it normally correcting lower after the Federal Reserve starts cutting interest rates before resuming its rally about 10 to 12 weeks later on average. So that advice I gave you not too long ago about selling or hedging your positions, spot on. It was a smart move to protect against this predictable pullback. Now, let's take a look, because we already know that gold's up 65% in the last year. And honestly, my friends, profit taking, never a bad idea. But I want you to see this chart about the median move around the first and second rate cuts. This is going to drive things home. Because what you can see here in black is typically gold rallies after the first Fed rate cut and then sells off before resuming its rally. Now, that gold line, there's the critical one. What it's suggesting, or that brown line, is saying that gold's move after the Fed September rate cut, well, you can see it clearly comes down. And that's where we're at right now. Now, this would take gold down right around 38.40, maybe in a worst case scenario, as low as 3,100 based on some fair value models against this liquidity squeeze. But what do you think? Is it going to go down? Are you buying it up? What's your play here? What do you think? But the real thing is, why does this matter? Because as liquidity stresses mount and subprime will spread, that correction could signal the economy tipping into shutdown territory. Well, gold eventually shines again. But right now, why is it selling off? Because it had a big rally and it wants to shake out the weak hands. Now, because you think back, what did I talk about last week when he did the show on gold? Everybody was long and they didn't have insurance. So if you don't think people are going to sell here, don't worry, they will. And if you haven't, or maybe you haven't hedged, this is your chance to take some profits, hedge your positions before it comes down even more. And while most people think that rate cuts are bullish for stocks, I got one chart to show you why perhaps we're seeing some red today. Let's flip over and take a look at the federal funds rate versus the NASDAQ 100. And what you can see very clearly as we go into the dot-com bubble, the stock market was kind of headed higher. It pulled back and was rallying, kind of like what's now. And then the Fed starts to aggressively cut. And next thing you know, the labor market goes and the stock market follows. We see the same thing happen going into the financial crisis. The Fed's cutting, market saying, hey, this is great, we're going to go higher, until it realizes that the Fed is in panic mode, and next thing you know, stocks completely come crumbling down. However, we didn't see that going into the pandemic, as everyone took rate cuts as bullish and kept buying, and sure enough, stocks went up. This time, I want to know what you think. Do we see a massive correction, or are stocks immune to the downside risk? Because we've confronted the beast of the Fed now. The Fed's cuts and QT end are pumping some short-term juice in the system. They're trying to solve that repo problem. They're trying to get those that have money to come out and lend. And the problem is they don't want stocks to drop. Now the issue here, if subprime cracks continue to widen under this dollar drought, and they should, if the Fed's moves here don't work, the recession odds skyrocket to about 30% or more next year. This is per Goldman. But if holiday spending disappoints and businesses start to shut down or lay people off, that number is going to skyrocket in the first quarter of next year. So I want you to be bracing for that December data. We're going to assume the government comes back online at some point, and without the economic data right now, the Fed is flying blind. But if the day is bad, it'll signal another cut in December. So here's what you need to do right now before the Fed cuts again, because once they start, and we've talked about this, they don't stop because the economy's unwinding and they're playing chase. That means markets likely to come down. Fed at this point would head all the way back to zero. If you don't think QE will restart, it's going to be bigger than ever. Here's what you need to do. Lock in your savings yields now before the Fed continues to cut. Take profits on those high-flying tech stocks and put some money into defensive. If you're a long-term holder of gold, maybe it's time to hedge. If you're a trader, look to sell and re-enter on the dip. And look to add dollars and treasuries to your portfolio, because if the Fed cuts us right into the next recession, which I think is highly likely here, these moves will help you thrive, not just survive the coming crisis. And something else we think will be a big boost to your portfolio, that is the stock for our sponsor for today's show, Biotech. You can find them on the NASDAQ and the symbol ONCY. Everything you need to know in the pinned comment and description below. Because Biotech is developing PaleoRep, an innovative cancer therapy delivered by IV. This treatment helps the immune system target cancer cells, showing promise in pancreatic and gastrointestinal cancers. It's earned FDA fast-track designations for pancreatic and breast cancer, as Oncolytics is pushing to bring the therapy to patients through smart clinical plans. Now, PaleoRep is a first-of-its-kind therapy that makes cancer cells visible to the immune system. It multiplies inside tumors, causing them to burst while sparing healthy cells. It also turns cold tumors into hot ones, triggering immediate and long-lasting immune attacks. This dual action positions PaleoRep as a powerful partner for other cancer treatments. Now, cancer affects millions, with over 1.9 million new cases in the U.S. per year. This is according to the American Cancer Society. Pancreatic and gastrointestinal cancers are especially deadly, with few effective treatments. PaleoRep is advancing rapidly in pancreatic cancer through the Goblet Study Cohort 5, a first-line metastatic trial that's building on Cohort 1's impressive 62% response rate. For anal cancer, the updated Goblet data shows a 30% response rate with PaleoRep in 20 patients. Median responses last about 15.5 months, with 2 complete responses over a year, including one beyond 2 years. And like Ambrx, Oncolytics is an overnight success, 20 years in the making. Proven science now gaining attention in immunotherapy. Ambrx started near a $50 million market cap before Johnson & Johnson bought it over $2 billion. Oncolytics sits in a similar spot. Strong safety, solid efficacy, and a platform potential targeting the RAS pathway, one of oncology's hottest areas. And while RevMed at $8 billion and CG Oncology at $3 billion chase single targets, PaleoRep has broad potential across the $16 billion GI tumor market, pairing with multiple therapies to reshape cancer treatment. And something we think could reshape your portfolio, that is ONCY. Again, you can find them on the NASDAQ. Let's take a look at this setup, because if you're an Elliott wave trader, you have wave 1, a pullback into wave 2. There's the third wave. Wave 4 holding its 6-month volume profile, looking to set up a big move higher and a potential breakout over $1.51 per share. Biotech is a leader in cancer innovation. PaleoRep's ability to destroy tumors and boost immunity is unique. With FDA fast-track designations and promising clinical plans, Oncolytics is poised to make a big impact. This company is creating exciting possibilities for patients in biotech. Keep an eye on the NASDAQ under the symbol ONCY. And as always, with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades, and use your risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.